Ja, meine Damen und Herren, der nächste Block ist kein Live-Trading und auch kein Vortrag, sondern ein Interview in der Thematik der Wandel des Schweizer Franken. Und ich freue mich sehr, dass ich Peter Rosenstreich begrüßen darf, hier bei mir auf der Bühne. Er ist Head Strategist Swissquote und Leiter des globalen Strategieteams. Ich bitte um einen recht herzlichen Applaus für Peter Rosenstreich. So I guess we'll just sit here.
Okay. Gotta get used to my voice
Sounding
coming
over
back
the
at me
system.
so fast.
You just told me you're since 10 years in the French part of Switzerland, so we speak German or French?
I think I would embarrass myself and the language if I have two little daughters who speak fluent French and are pretty good in German as well. And whenever I do speak French or German, they say, "No, Daddy, no, please stop." So I've learned very quickly that perhaps I should stick with the language I know. But
Good.
next time, maybe
Next
we'll
time,
do a little bit.
we're
Swiss
counting
German.
on it. So
Very
we're
good.
going to do this interview in English, and let's talk Tacheles.
Yep.
What is the primary driver of global asset prices?
So that's a great question. I think that's one that is quite difficult to look at right now. There's a lot of noise in the environment right now. When you look at things like Donald Trump and North Korea, the political environment in Europe. I think what is most important and what traders need to keep an eye on is central bank monetary policy. If you look at the last 10 years, if you look at, say, the expansion of balance sheets globally, things like the S&B, the Fed, the ECB, the PBOC, you can see a massive expansion in their monetary policy and their balance sheet. And it correlates nearly perfectly with the rise of, say, the equity indicator with the MSCI World. So basically what you can extrapolate from that is that central bank monetary policy, expansionist policy, has been a primary driver of asset prices. And therefore you can take it to the next step, which is that if we're in a period now where monetary policy is shifting, if central banks are preparing to change their strategy, we know the ECB is preparing to decelerate their asset purchases. We know the Fed just recently stepped in terms of reducing their balance sheet as well. We have the Bank of Canada, hawkish comments from the BOE, that if the central banks do start moving towards a tighter monetary policy, then we should expect pretty severe reactions in asset prices. So the answer to your question, in our view, is focus purely not on the noise, not on the headlines, but what central banks are doing specifically.
Mm-hmm. Now, what drives FX markets? Specifically Swiss francs pricing.
Yeah, again, it's monetary policy. And this is really critical for people that trade the Swiss franc, people that trade the dollar and the euro at these points, because all of those central banks are basically at a turning point. And we see that recently, in the last, I would say, 2 weeks, we've seen a strong resurgence in expectations for what the dollar might do and what the Fed might do. And that's caused, significant strength in dollar, both in the G10 area as well as the emerging markets as well. So we need now to see what the ECB potentially could do and their approach to both inflation as well as a stronger euro. So in our view, what's moving the FX markets, again, is monetary policy and policy divergence. For the Swiss franc, it's very critical to pay attention to what's happening in Europe above what's happening at the Swiss National Bank, because for the most part, the S&B is not going to do anything. The question is, how will Draghi deal with the rejuvenated European economic situation? It's been quite a while since we've talked about how well Europe is doing. In fact, the beginning of the year, the concern was the political stability when we talked about the German elections, the French elections, the Dutch elections. We have the Catalonian referendum. We have the Italian election coming down the pipe. These all sort of distorted what people looked at. But again, if we're trading the Swiss franc, it needs to be what's happening with Europe and the ECB.
So let's talk a bit more about the Swiss franc. Does the Swiss economic outlook justify a weaker Swiss franc?
So, this is one that's highly debated, right? If you look at a trade-weighted average, if you look at traditional economic models, PPI and such, then the Swiss franc is still very overvalued in real terms. And if you speak to the S&B and the S&B members, they will be very clear that the Swiss franc remains significantly overvalued. They did change their tone just recently, removing the term significantly from their analysis of the Swiss franc. But in their view, the justification for allowing further weakness in Swiss franc really is there. When you delve down from a bottom-up approach into what is happening on the ground, you have a very divergent situation. On one hand, you have real growth that continues to decelerate. In fact, the most recent Q2 numbers came out significantly disappointing in terms of GDP growth, about 0.3. We had the projections by the S&B themselves drop for 2017 GDP earnings, GDP growth at about 1% or 0.9%. So there's a concern that there's a significant deceleration in the Swiss economy. I would say that I think most of it is transitory. If you look at private consumption, if you look at imports, all of those are pointing to a relatively strong Swiss economy. So I wouldn't get too down on the weaker GDP reads, and we expect Q3 and Q4 in Switzerland to improve. Mm-hmm. On the other hand, which I think is quite sort of concerning, is the direction of inflation. Now, the S&B will tell you that these are transitory effects having to do with import prices, specifically energy, and that the recent uptick in inflation is going to fade, especially considering the drag that we're seeing on the growth side. But on the other hand, things are quite good, both here in Switzerland. It's still extremely wealthy economy. The service sector is still extremely strong, and probably more important, the recovery in Europe, the strong economic data, the strong domestic demand in Europe, the good labor markets, all suggest that exports to Switzerland's primary trading partner, Europe, will continue to improve. So that is likely to continue to put pressure on inflation and put the Swiss National Bank in a relatively difficult term. On one hand, you have an overvalued Swiss franc. On the other end, and you have a decelerating growth environment. But at the same time, you have inflation slightly grinding towards that 2% threshold, where having an ultra-loose monetary policy no longer is appropriate. So, yes, the Swiss franc should be undervalued at this, or sort of overvalued, and will continue to lose value. But if we keep seeing inflation moving in the direction that it's trending, I think it'll become a difficult proposition for the Swiss National Bank.
Yeah, you just said before that the S&B subtly shifted the language regarding the Swiss franc in their monetary policy assessment. Now, what is your very own perspective?
Well, we are, very concerned about inflation. I think that is something that, bond traders have made a fortune betting against central banks' inflation forecasts. In the last 5 years especially, every time Draghi would come out and say inflation's picking up, or Yellen would come out and say, things were optimistic, labor markets, inevitably the dots in the Fed or the inflation forecast in the ECB would underwhelm, and bond traders love that because it's an easy money maker for them. But I think this time there is a real concern that the global strength will cause inflation to reverse. And I think we're in a very interesting situation in that, especially in the United States, the general economic theories that drive people's thinking on inflation, like the Phillips curve, have been thrown out, have been completely disregarded because they haven't produced the accurate results. And I think Yellen's primary concern is what happens if, just as fast as we've thrown those economic theories away, that they re-entrench themselves. And then all of a sudden we have a snap back. If the fact that the U.S. has unemployment at 4.3%, you look at job openings have reached all-time highs, initial jobless claims are continue to drop. What happens if this turns around very quickly? So in our mind, we are quite concerned about the idea that inflation, considering the speed of money and the amount of expansion that we've seen in central banks' balance sheets, that inflation picks up and picks up quickly. So I think bring it back to Switzerland, I think it's important to keep your eye on inflation, because I think there are inputs that makes the market quite sort of flat-footed or are underappreciating what possibly could happen in terms of pricing and price pressures very quickly, especially when you're dealing with a small economy like Switzerland that is subject to externals and externalities, which means that the S&B has less control than they would like, and Europe and the ECB actually influence significantly more pressure. So on our view, I think we are quite focused on inflation, making sure that the current uptick in inflation is transitory, and that we don't see a quick reversal. And that will help us trade for the next 3 to 6 months, especially around the Swiss franc.
And what are your expectations for the S&B monetary policy strategy?
So, we continue to have a very benign, very, we don't see much. We see the recent change in language, as you mentioned before, going from significant to removing the term significant to keeping just overvalued. And we think that was not so much a signal to the market that potentially something might change, or there may a new type of strategy, maybe their defense of the Swiss franc will be lowered, or maybe even something more radical like a change in interest rates, but rather a testing of the market to see how reactive the market will be to any type of language or actionable strategy change by the S&B. So we think that's more sort of a one-off, and we don't expect any significant change in 2017 or until the sort of mid-2018, given the current sort of projections and forecasts.
In the FX markets, where are some of the bright spots?
Okay, so this is a very, I think, a timely question.
Oh.
What are you going to say?
No, go ahead.
No, so I'll start by saying that I think there's two unique terms or sort of durations that we're looking at. One is the next 3 months. And we do believe that the market has undervalued the drive for the U.S. Fed and determination to normalize monetary policy. And it's interesting because just 2 weeks ago, everywhere you looked, Financial Times, Wall Street Journal, CNBC, it was basically the end of the dollar. This is it. We're in a Goldilocks period. Trump's monetary policy, Trump's policies are going nowhere. People are avoiding the dollar as a safe haven because they're starting wars in the Korean Peninsula. Yellen is not going to do anything because there's a stagnation in inflation. But we think that Yellen has something up her sleeve, which is that she has a determination to normalize monetary policy just in case something comes down the line. It's very uncomfortable for central bankers to turn around and look at their quote-unquote toolbox, what tools they have to adjust monetary policy, and see that they don't have anything, right? If you have interest rates below 1%, If you have, say, I don't know, well, the $4.5 trillion on their balance sheet, there's not, they've tried to quantitative easing, 1, 2, 3, they've done yield curve twisting, they've done it all. So the question is, if something happens in the US, if there is a shock in any form, there's very little Yellen can do about it. So I think her motivation is not so much sort of quote unquote price stability or full employment, but normalizing policy to a position where they have the tools to react. So we think that, so a lot of traders are very much focused on Friday's PCE numbers, which are going to be extremely important because it's going to show the direction of inflation. But we would say take less of a direct view on the data and more the underlying sort of motivation. And on this case, we think that the market is flat-footed, and people should be looking to accumulate dollars at this point. If you look at Fed pricing, about 60% of pricing for a 25 basis point hike in December is already priced in. So there's about 40% that's unpriced at this point for a December hike. So there's significant room to move as that rate hike solidifies in the market, first of all. And we think that just 3 interest rate hikes in 2018 remains on the very low side. So we think that in the near term, when people realize the motivation is not purely on inflation, but to get to a normalized position, we think the yields are going to drive significantly higher and cause the dollar to strengthen both in the G10 and the what we call high beta or high risk EM currencies, things like the Turkish lira, things a bit like the South African ZAR are extremely exposed to a rally in the US yield curve. And then if we take the next piece, say 3 to 6 months, we think there will be a period of sort of calmer, where people have adjusted to the yield differential in the U.S., and they start looking at sort of the global environment where we see trade data improve, we see global demand improve, we see domestic spending in emerging markets continue to improve. And that is sort of the Goldilocks conditions. And that should be good for, high yielding currencies, commodity currencies. It should be good for equity markets. The whole world is saying, okay, look at valuations. There's no cheap, there's no good value out there. But if you look at a forward curve and you look at the 12-month forward earnings expectations, they're quite solid. And you put it behind a environment that encourages companies to continue to pull in revenue. Valuations don't look as high, especially if you compare them to where they have been historically. So we think there's 2 distinct phases in the next 3 to 12 months. One is a dollar rally, and then a sort of resurgence of risk-taking, yield-seeking, equity market improvement environment.
Just a personal question. We talked about Trump before, and also here, and you talked about Trump. Just how do you see him, his politics, influence the market?
Well, I think the market has gotten to the point where it's discounting a lot of what he says, and even actions around his tweets, I guess. You can't even call it policy, can you? And you're talking about 120 character
no, really.
Decisions.
Yeah.
Right? Oh, I'm sorry. When I say that when South Korea starts a verbal war and Trump responds, you see very little reaction in the FX market, and you see even less in equities, which is astounding. North Korea sends a missile to Japan, and the Nikkei is down for maybe 15 minutes and comes back. So I think from a global macro standpoint, the world is discounting Trump. And I think that's probably a good thing. From a domestic standpoint, will he have the ability to put back that sort of Trump trade? And I think this is one that probably is a little more open. He recently, as everybody knows, it's amazing how in tune the world is with the Trump situation. And maybe this is the merger of our two worlds. You know, it's become financial markets. At the same, it's sort of pop culture. You know, you mentioned Trump in the same breath as you do Kardashians and
pop stars,
and pop stars and things like that. So I think it's quite interesting how much people know about politics in the U.S. because of this boisterous gentleman. So from a domestic standpoint, his growth or pro-growth reflation strategy, that was the big trade after his election from November until his inauguration, could start coming back into effect. So, you have all of these infrastructure plays, you have all these banking plays in the U.S. that sort of have fallen off. But if you talk about $200 billion of infrastructure or fiscal spending because of the recent hurricanes in the U.S. You put on top of that a tax reform that is increasingly more and more likely with his ability to cross the aisle and pull Democrats into the folds. Remember, he's historically a Democrat. It increases the likelihood that the U.S., which is already accelerating at about 2.2% GDP growth, could get a sort of another stimulus package. So, Trump in his policies, is to me is just boggles my mind, and I spend most of my evenings at dinner parties trying to explain people, what exactly is happening, which I have a very difficult time. But from an investing standpoint, I think things are setting up themselves for not the correction that the world is waiting for, right? It's been one of the longest bull runs. It is the longest bull run in equity history. It's almost for 9 years straight, and everybody wants a correction. Everybody believes that the correction, but the truth of the matter is, there's very little signals that something like this would happen. So on a Trump standpoint, I think internationally, if you're trading global macro, I wouldn't worry about him. Every time that he tweets and we see a pullback in risk, I would go right in as a bull buying up risky assets.
Okay.
And domestically, I think there is a pure Trump trade to be had because I do believe that in the 6 to 12 months, we start seeing things work out in his favor.
Good. Well, we're almost at the end.
Okay,
here.
all right. I was just warming up.
You may afterwards. I mean, I'm sure there are going to be lots of questions.
I hope so. I hope so. Yeah, I
sure
hope
of that.
One of the problems with being from New York, I generally talk very fast and with my hands, and sometimes I need somebody to raise their hand and say, Peter, slow it down and calm down because.
I'm sure
I'm using one gentleman here as my, when he shakes his head after I say something, I know that he disagrees with me and he also understands what I'm saying. So I appreciate that.
So one last question. You told us a lot. What are the primary risks to your outlook?
Well, I think the one is the reflation trade, which we sort of went on, pretty heavily. So I'm not. But I think one of the biggest things is I keep on reading about Catalonia and the Spanish election, and I just had a lunch with some reporters, and I said, how come you're not covering? So on October 1st, I believe Sunday, Catalonia may or may not vote on secession from Spain, and there just doesn't seem to be the proper coverage for this type of event. And as I'm sure everybody can attest to this, markets have an unbelievable ability to sneak up and present you with a dilemma that you never saw coming. And one of our biggest challenges as strategists is trying to figure out where the next risk is. And when I look at what's happening in Catalonia, and I don't really understand what the solution, what the outcome might be, I get very concerned. And I think, the other piece is that the last, Netherlands, Europe has survived a number of political events in the last 12 months extraordinarily well. Too well. We brace ourselves, okay, this is it. This is the breakup of the Europe. This is the rise of the populist vote. The anti-European sentiment is going to, the far right, But it pans out to be pretty much nothing, right? And so the fact that everybody's looking somewhere else, and this event is happening in Spain, does concern me. And they say, well, what do you expect to happen? That's the question. That's really what concerns me. I don't know. So they have the referendum, one way or the other. Maybe it's just a vote in the streets, and the secession crowd stands up and says, we have the majority, and Madrid says, no, you don't, and they say, yes, we do, and they say, no, you don't, yes, we do, and what happens next? I mean, do you have a Maiden Square Ukraine situation? Are people willing to go that far? I think that really concerns me, and I think if we can survive that, and it goes off without a hitch on Sunday, I would be very concerned about a gap open on Monday if I was an equity trader or a euro-dollar trader when we open Sunday night. I think things will smooth out exceptionally well.
Let's hope so.
Let's hope so. Definitely.
So thank you very much,
Peter Rosenberg,
and I will bring you to Terminal
Okay,
1. So,
Terminal 1?
Yes.
Okay.
Just a minute, I'll come with you. Peter Rosenschreier is now open for questions, and I will be back in a few minutes. So thank you very much.
Okay.
That's your applause.